Good afternoon, everyone. My name is Sheena Bezimer, and I am the Program Manager for IDFA here in Canada. Thank you for joining us for our July webinar with John Panagakos. Before we get started, I'd like to address a few housekeeping issues. First off, every CDFA who attends this webinar will receive 1 hour of CE credit. The credit will be applied to your account within the next 2 weeks. We will also be sending a recording of the webinar and a follow-up email, as well as any material that John is sharing with us today. If you have any questions during the webinar, please enter them into the chat box or questions box of your GoToWebinar menu. We'll get to as many as we can during the presentation, and you'll also be provided with John's contact information at the end of the webinar for any other questions that you may have. Lastly, just a quick reminder that the early bird promotion for IDFA's annual conference that is being held this November 13th to the 15th in Toronto ends this Thursday. Be sure to sign up by then to receive 15% off your conference pass. Finally, a little bit about John. As a Toronto native, John knows his city and neighbors well, and as a father of 2, he understands the importance of finding the right home for your family. This includes addressing concerns about location, financing options, and building a support network that helps your family grow and thrive. After extensive post-secondary studies in finance, John spent 6 years advising his clients at one of Canada's largest banks. When he moved to Safebridge Financial Group in 2010, John specialized as a mortgage agent, developing an expertise in separation mortgage financing. He has now trademarked his separation mortgage practice with plans to enhance collaboration with the family law community to set a more comprehensive level of care in this important field. His unique system has helped many clients eliminate over $60,000 worth of individual mortgage debt, generate additional equity in their home, and create financial freedom. In addition, John is very active with numerous charities, including the Greek-Canadian Games, and the Make-A-Wish Foundation, and the Santa Claus Parade. Now we'll turn it over to John.
Hi, everybody. For those of you that don't know me, my name is John Panagakos. My contact information is on the screen in front of you. This is actually the first time I've actually done a webinar, not the first time I've actually done a presentation like this. Those of you that want to follow me, I guess, on Twitter or on LinkedIn, feel free to do so. I have yet to make a tweet, only because we're getting a lot of information compiled to make it relevant to what it is that we want to tweet about or inform people about. My hopes with this presentation is that many of you, if not all of you, have a lot of what I call aha moments. So ideally, you learn, 8 to 10 different things or new things about whether it's the mortgage industry or mortgages specific to separation and divorce. And for the purposes of compliance, I am a mortgage agent. I often refer to myself in presentations as a broker, but I always say, hey, I am an agent, but if I ever use the term broker, I really mean agent, just in case someone listens to this presentation and I don't want to get myself in trouble. So the presentation itself should be 20 to 30 minutes, and then hopefully you guys have lots of questions for me. You have my email address there, and if you wanted to ever email me a question, or if you wanted to just simply call me, I'm always up for a conversation, or taking people out to lunch or what have you. It would be my pleasure to be able to host you for a lunch or afternoon beverage. So on with the presentation. Today's agenda, it's very straightforward. It's a simple introduction, industry overview, and really I want to talk about, I think I have 4 or 5 different case studies. They're actual real life case studies that we've handled, and really how we've put clients in a far better position, and what we really do to enhance client experience when it comes to getting them a mortgage specifically to separation or divorce, and obviously some Q&A at the end. So, who is John Panagakos? Great introduction. I really appreciate the introduction that was provided earlier. A little bit about me, other than what you see in front of you, is I'm very active in the community. As you can tell by my last name, I am Greek, so I do participate in various community events I also am, believe it or not, I am a clown in the Santa Claus Parade. So for those of you that watch it every November, I'm one of the first 200 people cheering on the crowd, or and making them smile and making their day with anticipation of seeing Santa at the end. And more about me professionally. I've been an agent for probably about 7 years. Before that, I was working at a big bank. So I've been in the industry probably, I don't know, 14 maybe years, give or take. I'm an author with LexisNexis. I think that's spelled incorrectly, but I might be wrong. LexisNexis, for those of you that don't know, they are a very large online publication for lawyers, and they've recently created a family law division, and they've asked me to provide material specific to separation and divorce. I have written about, I want to say about 18 different articles for them. They were in the last stage of editing, so they should be published at the end of the, I want to say at the end of the month, if not a little bit later, and then those will all be available through Twitter and through my LinkedIn for those of you that find this of interest. My focus is on separation mortgage financing. I do the regular purchases for people that aren't separating or divorcing, obviously. Probably, I don't know in how many years, my sole practice will probably be separation and divorce mortgage financing. I find it's a little bit different, a little bit more of a challenge. I'm not sure if anyone on the presentation knows what collaboratively trained is. I've completed level 1. I've signed up for level 2. Unfortunately, they had to postpone the course, so I will be taking it again in the near future to be fully collaboratively trained. And what that really does is it allows me to respect the process of people who are going through separation and divorce when they're sitting at a table negotiating with lawyers and other financial people. I can actually sit at a table if I'm required to do so, but I'm also able to help really understand and provide a voice for clients, and that's in order to get them what they want and for them to understand what their mortgage is all about, and that's something that the collaborative training has helped me do. So what is a separation mortgage? A separation mortgage is really, it's a unique, I'm just going to try and move this somewhere, pardon me for a sec. I'm not sure if we can move this. A separation mortgage is really just a unique mortgage service targeted to specific people. And the next slide is, there's really 4 categories of people that we cater to. It's married people who are separating or divorcing who own a home, individuals, i.e. friends or relatives who purchase a home together, common law couples with a cohabitation agreement who intend to purchase a home together. It could also be common law couples without a cohabitation agreement who intend to purchase a home together, and couples who are already separated, or people that are already separated and want to purchase or refinance their home. And this is where I find the majority of people who are separating or in the separation process, or people that are trying to buy a property, whether they're common law or already married. And there is information that we provide them with in order to make the best decisions, or have them make very informed decisions on how to best get a mortgage or obtain a mortgage. So what is our role? Our role is really simple. Our role is to provide clients with various mortgage options, explain the terms and the conditions of each possible solution, and instruct them on the necessary steps on how to qualify for a mortgage. For those of you that don't know, all mortgages have terms and conditions associated with them. Some good and others not so good. So what we really try and do is really inform people with what they're signing, what they're getting themselves into. And I found in the last probably 7 years that with the internet, which is good and bad, that consumers are really informed for the most part. Everything's at our fingertips. Everyone has an iPhone or a BlackBerry or an Android, so you can quickly look things up. And quite often people will come into my office and they will say, what's your lowest rate, or I saw this advertised in the newspaper or anything like that, and what we offer is something way more valuable than just a really low rate. Do we have access to low rates? Yes, absolutely we do. So does everybody. But what we find is that people's wealth is really, you can either make or break your wealth by choosing or selecting the right mortgage product or the wrong mortgage product for that matter. With separation mortgage financing, we often see clients who come to us and have prepared a mortgage with, whether it's they did it on their own or with another broker or whoever, and they come to us and they're like, oh, we're separating, our legal bills rather are 30, 40 grand, 50 grand, or whatever they are, and now we have a mortgage penalty of $27,000 or $40,000, and we had no idea. How do we get ourselves out of this, or what can we do to avoid this penalty, as an example? So if we go back a couple slides, which I'm not going to actually go back on a couple slides, but one of the things that we do is we cater to people who are, whether you're common law and buying, or two friends that are buying a property together. And so we try and make sure that if they're purchasing a property together, or if you're purchasing a property by yourself, that you get arguably the best mortgage product in the marketplace, or one of the best mortgage products in the marketplace, in order for you to eliminate or decrease as much as possible your mortgage penalty. Here are just a few of our lenders. And so what I've really done is just really cut and paste a few logos from the internet. So we're lucky. So I'm a mortgage agent with a company called Bridge Financial Group. We have access to about 70 different lenders, banks included, and these are just some of them. So some of you may or may not have heard of, Merrick's, RMG, MCAP, or Street Capital. These are really non-bank lending institutions, whereas probably the vast majority of you have heard of Scotia or TD or Equitable or or Duca Credit Union, stuff like that, or the infamous Home Trust. So we deal with just about everybody, and the good news about that is that we are able to, based on everyone's unique situation, we are able to find the appropriate lender and mortgage rate for each person's unique situation. So do we always go to a bank? Sometimes we do, sometimes we don't, and we really just explain to clients, what are the pitfalls of going to Scotia, for example, or what are the pitfalls of going to Street Capital or whatever. And I want to make it perfectly clear that I'm not trying to pick on or bank bash or broker bash anybody. This is sort of just a statement that I'm trying to make, just to help prove a point. So the next slide is there's basically, I want to say, 6 different types of lending institutions. So we have your everyday banks. So some people will go to their corner bank or their community bank, and whether you get your credit card or your mortgage there, we have access to just about every bank in the country, which is really nice, and we're able to offer these types of services to clients. Monoline lenders, so monoline, these are our non-bank lenders. So if you go back to the previous slide, like the RMGs or the Merrick's or the Street Capitals of the world, so they primarily only deal with mortgage money. They won't offer you a car loan or anything like that, or a credit card for that matter. We have what's called quote-unquote B lenders. I really call them more the alternative risks. So there are lenders who, if you have poor credit, or you don't necessarily declare as much money as you should have on your taxes, and you want to qualify for a mortgage, so they have a greater risk. They have a greater risk appetite, or appetite to risk. So they're able to provide alternative mortgages for people, so they can still qualify for or refinance their house. Credit unions, obviously, I think we all know what a credit union is. Mortgage investment corporations, or AKA MICs. So a MIC is really typically it's like a group of investors who invest in people's mortgages. Different from a private mortgage. They have a much higher appetite for risk than your everyday bank or your alternative risk markets. And then obviously private lenders. So we have access to a group of people who will actually loan their own personal money. It's up to the private lender to determine his or her risk appetite, or sorry, their risk appetite, and they're the ones that deal with their they determine the rates, the terms and conditions, and we try and broker deals between them and clients. So moving on to the case studies. So this is a case, one case that we dealt with not too long ago. It's the newly married. So here's the overview. So the client really went to their bank, or it was another broker. I'm not sure which one it was. And what they were promised was a low rate repeatedly. There was little or no consultation. They waited many weeks for paperwork. They were offered an extremely dangerous product, and also offered VIP banking. So the way we were introduced to the client was one of our lawyer friends said, "Hey, you know, the client was obviously not thrilled with the service and lack of answers that they were getting." So the lawyer said, "Hey, why don't you talk to this guy John I know, and he could probably help you out." So we sat down with the client. Initially it was about a 75-minute consultation with several follow-up conversations. We provided several options, explained the pros and cons of each possible solution, including their initial offer. And then we were able to provide paperwork within about 48 hours, which is, in my opinion, a very quick turnaround. And then the result was that the client selected a shorter-term mortgage to consolidate their student debt into the future equity of their home. They reduced their risk exposure and increased their cash flow, which is really, really important, especially these days with Toronto real estate or Ontario real estate the way it's going. Cash flow is king. Needless to say, unfortunately, the clients did divorce, and the mortgage penalty was the lowest that it could possibly be, instead of the $35,000 mortgage penalty that they would have had with their initial offer. So what we try and do is, in this case, we actually just sat down to the client and listened to what they wanted, and listened to what they had, and we really explained to them the risks of what they were going to get themselves into. And luckily, you know, they just weren't issued paperwork, so they didn't even have the opportunity to even sign up for that mortgage, or at least I don't think they were offered paperwork. They were just simply offered rates. So in this case, you know, they ended up divorcing, and in addition to their lawyer fees, they only had a small mortgage penalty, as opposed to something that could have really been detrimental to their situation. Here's another one. This was actually, if I'm remembering this correctly, the separating couple. No, these weren't personal friends of mine. This is a separating couple. Mortgage was renewing, so they're going through a separation, and the mortgage is up for renewal, say July 1st or August 1st. So this is the scenario that they were in. They simply just went to their back to their broker or back to their bank, and then the person who they were speaking with simply suggested a 5-year fixed term with that particular institution, and said, "Hey, and we can increase your credit card limit," which wasn't what the client really wanted. And so again, the lawyer, when they were negotiating the terms of their separation, found out what was happening. This happened to be another lawyer from the previous case study that we just discussed. He called me up and he said, "You need to talk to these clients right away." So there's no there's no secret that some 5-year fixed rates are the worst decision any mortgage holder can get themselves into, especially in this case when people are in the process of a separation or divorce. Typically, a separation, in my experience, doesn't take too long, and that's also just relative. And I think this case was maybe just within the year or within about 6 months or whatever the case was. And so when we spoke to them, we had a quick 90-minute consultation, obviously several phone calls between the consultation and paperwork being issued, and we provided the clients with about 3 hours, and again we were able to provide quick paperwork. And the result was clients decided to take a 1-year fixed, no mortgage penalty, and both were able to buy new homes after their agreement was completed and signed off on. The original option would have provided them, I believe it was a $46,000 penalty with no future home purchase. So as a result, the $46,000 would have, that penalty would not have allowed, I believe it was just one of the two of the clients not to purchase another home. But in this case, both clients were able to move on. The relationship was dissolved, and both clients were able to purchase 2 homes, or one each, rather. So this is the double divorce. This was actually 2 friends of mine, and this is one of the most difficult cases that I've handled. One of the most difficult files that I've handled, and we're actually quite proud of this one. So this particular case, it was, I believe it was it was a boyfriend and girlfriend who came together, who decided to buy a house together, and they were each of them was divorced. One had a signed separation agreement. The other person did not have a signed agreement, and his ex-wife or his separated wife was, for whatever reason, was holding up the paperwork, or the situation was that they couldn't come to an agreement and there wasn't a signed agreement forthcoming in the near future. So this was very challenging. We learned a lot from this file. So what happened was their sort of the other bank or the other broker or whoever they were dealing with, it was just multiple delays. It was just delay after delay after delay after delay, and no option. Simply, there was no option because the case itself, for the file itself, was extremely difficult, even for the for a mortgage broker or for a mortgage agent that is that is involved in these files on a daily basis. We provided a quick consultation, provided 3 solutions, and we were able to work with their home. We were able to work with them to purchase their home with no signed agreement, which is very difficult to do. And then paperwork was issued within about 4 days. The reason for, I say, a delay in paperwork is because the file was so difficult. We had to go to, I can't remember the lender that we used, but we had to really go to upper management and really present the file properly to them, and really have various discussions with the lending institution to say, hey, this is what's really happening. And what was happening is it is really difficult to get a mortgage where there's no signed agreement in place. So the client's family lawyer, how we got this done was the client's family lawyer wrote up a worst case scenario for those of you that are familiar with DivorceMate. So they were using the DivorceMate's calculations. The lawyer agreed and signed off on this document. Our chosen lender, one of Canada's leading financial institutions, accepted it and approved this mortgage. The document that the lawyer provided us with was, I want to say it was about 27 pages. I don't think it, I say 27 pages, but I don't even think it took her all that long to put together. But what it did was it created like a worst case scenario in terms of once a signed separation agreement is in place, what's the worst amount of money that, or what's the highest amount of money that, say, Bob the client can pay out to his ex-wife on a monthly basis. So the lender agreed based on divorce maintenance calculations. So we just took it on a worst case. Once the separation agreement, we were able to fund the mortgage. We met the deadline, and once he signed his separation agreement, I think it was like a month or two after he got his mortgage and got his new house. It was even much lower. We didn't even have to. I don't think we even had to provide the lender the separation agreement post funding, but it was much lower, and we were really fortunate to be able to have this file be approved. It was a lot of good teamwork, and it was a lot of it was a lot of back to the drawing board and how do we make this work and make sure that the clients are excuse me are happy and can really get their house and a good mortgage. The separating client that needed to stay in their home. So quite often we run into these types of situations where, husband and wife separating, and one person wants to stay in the home, and then one person, moves across town or across the street or in the same neighborhood. These are probably some of the most common situations, but this one was slightly different, and we'll see as we move forward. So the separating couple, the female wanted to stay in the matrimonial home. The kids were finishing school in about 2 or 3 years, but had a difficult positive cash flow scenario. So what we did was they were trying to do it all on their own. I think they had a broker or a family friend, or I can't remember who was helping them. They simply could not qualify for the deal. The other person suggested, hey, sell the property. They couldn't qualify for a new mortgage, and the options took several weeks and lots of frustration for the client. For this particular client, when we sat down with her, it was really, really important for her to keep the home for many reasons. The ones that really stick out is it was just really important to her that she owned a home. It was, I believe it was like a cultural thing, right? It was really important that in her culture that they own property, that they own their house, and she didn't want to be a renter, and that's totally okay, and I totally respect that, and I understand their position, and we realized that when we were listening to her, and we asked several questions during our consultation, and one of them was, like, why is it important for you to keep the home? And this is what we realized. And once we realized, like, her voice was, I want to stay in their house. And they also had it was 2 or 3 kids who were finishing school, and she didn't want the kids, their school life to be disrupted by moving different neighborhoods or being in a different school district or in a different house. And these were important to her, and this was important to her and her kids. So client was not able to get a co-signer. We often ask, is there a mom, a dad, is there, a best friend or someone that can co-sign? In this case, there was not. We helped the client become cash flow positive, and we provided her with a couple of options. The result was we were able to get her a mortgage where she was able to prepay the mortgage for 2 years. She was cash flow positive for those 2 years. Well, she still is cash flow positive. And when the kids graduated, the client sold her home and for sizable profit. So there are mortgages where the client can sort of prepay the mortgage for about 2 years. So what we did was during her separation, what we did was we refinanced her house. We took out enough money to have what we call P&I, so principal and interest payments, deducted from the mortgage, from the refinance or from the equity of the home, and we were able to get her a mortgage. So she had a mortgage with no mortgage payments for 2 years that were already prepaid, and then all she had to do was she had to just work and live. So just her day-to-day expenses, so groceries, car, kids going to school or activities, dinners out, whatever the case was. So she was really happy with what we were able to do with it, and then she sold their home for a sizable profit. Those of you that know Toronto real estate, she did quite well, and she was able to buy another house and able to put cash in her pocket. So what we do for clients after the fact, and we started testing this probably in the last 8 months, is that all clients receive something called the Separation Mortgage Success Plan. It really is. It explains a lot of terms and terminology to clients. It tells them how to pay off the mortgage efficiently, if they need to add a payment, or what all these terms within their mortgage actually mean. And then we also add them to what we call our rate tracker. So every time someone does a mortgage with us, we will input their mortgage information in our rate tracker, and it will automatically inform the client if a competing institution has a better mortgage offering post-funding. So you have a mortgage today, we'll add it into our rate tracker, this afternoon, and then, in 6 months from now, if you're quote-unquote overpaying for your mortgage, our rate tracker will instantly notify myself and the client, and we'll say, hey, you know what, the company across the street or this lender or whoever is having a sale on money, or there's an opportunity. Would you like us to start the paperwork in order for you to save X amount of dollars? And then we'll clearly illustrate what the savings opportunity is for that client. And it's what we call a true savings opportunity. So it's post, so it's inclusive of mortgage penalty, and it's inclusive of the lawyer fee. So anytime you refinance a property, you have to get a lawyer involved, and typically that lawyer charges, I think it's like $1,250. So our trigger point for that, I believe, is $3,000. So anytime a client has a savings opportunity of greater, or $3,000 or greater, there is an instant notification to myself and to the client. We have a discussion, and most clients decide to move forward. Some don't, and that's okay. Never pressure on our end, but clients really, we tested this out. The rate tracker is consistent for everybody, but the separation mortgage success plan is very unique for separating and divorcing clients, and we've tested that out with several clients over the past, I want to say, 8 months, and we've taken it back to the drawing board. We're in the process of enhancing it a little bit, but people have come out and said, we love this. I can actually sit down in front of my, on my couch at night. Just on my iPad, I can learn something. So it's also a bit of an educational piece for clients. And then, when they're, one client said to me, she's like, I was at a dinner party, and we were just talking real estate, because that's what people in Toronto do, and we were having discussions on mortgages and all that stuff. And she's like, I was the smartest person in the room. Like, this was amazing. She was the focal point of a mortgage discussion, and she really appreciated the fact that we were able to give that to her. And like I said, most clients, if not all clients, really appreciate that also. What does the future bring for separation mortgages and our partners? I think the plan is to just become better at what we do. We are partnering with, I want to say, about 7 different people who are in the industry, not in the mortgage not in the mortgage industry, but in the family the family law industry, and who are going to be helping me be able to provide better service to clients in terms of what are the things that clients always need. Is it accountability? Is it providing certain service? The separation mortgage success plan is huge. So I'm working with a lot of them in order to be able to make sure that their clients or our clients are very well taken care of, because quite often this is how this kind of all started. Lawyers or whoever were giving referrals to various professionals, and they themselves were left in the dark and were never followed up with. So I've partnered, we're in the process of partnering up with about 7 different people, sort of saying, hey, let's create something where we're able to provide information back to the lawyer, and let's be able to provide information to the lawyer and say, hey, if you want if our client wants to qualify for a house, here's some tips on how to negotiate the separation agreement, or this is what has to be in the separation agreement, or this is what we suggest that you add in the separation agreement. And so far that has been quite positive. I think I'm looking for I think 3 or 4 mortgage professionals to come on board, and if that happens, great. If not, it is what it is. And I think that might be it for right now in terms of what I can say about the service. Thank you very much. I really appreciate everybody's time. I hope you learned something. I hope there's several questions that people can ask. And if there's something if there are questions that you have, not necessarily right now, but later on, call me. Feel free to email me. I'm really happy to have a conversation with you or with a group of people. Like I said, my goal is for people to have several, if not 8 to 10 aha moments. And if I've done that, great. And if I haven't, then I just haven't delivered my message. But really, what I'd like to do is, if you have some questions and don't want to ask them, feel free to call me, and we can sit down and just have a discussion so I can better communicate. And this is the question portion, and this is my contact information yet again. Thank you for the opportunity, and any questions that you guys have, I'm more than happy to answer them.
Thank you so much for your presentation, John. So while we're waiting for questions to come in, and everyone, if you have any questions for John, please feel free to type them into the questions box from your GoToWebinars menu. So John, you talked a bit throughout each case study about having a full consultation with your client rather than just collecting the basic information. What sort of questions do you typically ask, and what information are you looking for, and why is that approach so important?
Well, so I'm going to start sort of backwards, and I'm going to answer your question by why is it so important. And I find that with not always, but I find in many cases, if not most cases, that clients really want to be heard. They're going through a very difficult time. They're probably arguably going through the worst time of their life outside of a death, and they're really emotional in a lot of cases. And keep in mind, sometimes it is a relief that they're going through a separation or a divorce. I'm not going to discount that, but they often want to say, hey, this is what's important to me, and they're not always heard during their marriage, or they're not always heard during a negotiation process, or however they're going about, whichever way they're going about their divorce or their separation. But with us, we really want to know what's important to them, because this mortgage is always about them. Like this mortgage that I'm currently working on for someone that's separating, it's not about me. It's all about him. So I really want to make sure that he's comfortable, he knows what he's getting himself into, and understanding the terms and conditions, because later on, I never want to have a client to call me and say, why is my mortgage penalty so high? Or why can't I do this with my mortgage? I want my clients to always be like, yes, I fully understand what I'm getting myself into. John has explained everything, and I'm fully aware of what I'm getting myself into. This is sort of with all mortgages. All mortgages have terms and conditions, so we want to make sure that clients aren't really handcuffed to the mortgage, and they're able to do what they want. Some of the questions that we ask are, like when is the separation agreement scheduled to be signed, right? Like how quickly do you need this? That's probably one of the most important questions for everybody. Sometimes they say, oh, it's going to be about in a month. 6 months later we have a signed agreement. Do you need, what's your cash flow like? Are you cash flow positive? Are you cash flow negative? Do you have a budget? Would you like me to send you an Excel spreadsheet of a budget? A lot of people just don't know what they're spending on a monthly basis. Like, can they afford the mortgage? Right? Like in a lot of cases, you can get someone a mortgage, but if they can't afford the payment, then really, what's the point? right? So I don't look at a client in terms of, oh man, I'm going to make some money off of this. I'm going to I'm going to be able to, get that new car or take my wife out for dinner or anything like that. I really look at, can this person afford it? Is this also the best option for him or her? And have that discussion. Is it way better for the client to sell the property and rent, or sell the property and downgrade, or whatever? So those are just a few of the questions that we ask, and have them understand, that there will be a mortgage payment every month. And that's really important, because in a lot of marriages, it's one person that's taking care of the mortgage payment, the hydro bill, the electric bill, the phone bill, all that. And when you separate, or when two people separate, whether you like it or not, you yourself, if you didn't have that role before, you have that role now. So you also have to learn how to do that. We assist in some ways like that. So I hope that answers your question.
It does, definitely. And so we have a question from one of our attendees, Blair. What do you see as special terms, conditions, options that may specifically help separating clients? The prepaid option is an excellent one, as was the worst case scenario letter from the lawyer. A short-term and no penalty option is logical for renewing mortgage during divorce. Co-signing is another option. Any other thoughts for someone whose family income is now taking a big hit?
Good question, Blair. Very good question. I'm not a fan of there are certain mortgages out there that have like a collateral charge. I'm not a huge fan of that. Some mortgages have like a 3% mortgage penalty clause, or a 3% or penalty that's 3% of the mortgage balance at the time that you are breaking your mortgage. So let's say you have a mortgage of $500,000 and you're breaking it today. That mortgage penalty is $15,000. That's a lot of money, right? So and unfortunately, I think the stat is like 50% of people have the wrong mortgage. And so and quite often what happens is, people go on the internet or read the newspaper and they see a very inexpensive rate, and they're like, oh my God, this is what I want. And so whoever, the banker, the broker, the mortgage professional, whoever's facilitating that rate or is advertising that rate is going to facilitate that mortgage. And he or she may not disclose this information. They may disclose that information, and the client may not know what the 3% penalty means. So that's also important. There's also a no sale clause or a sale clause in some mortgages. So you can't refinance your mortgage midterm. The only way out of your mortgage is to sell the property. Well, what happens if you get like a 5-year fixed, and year 2 you have $20,000 or $30,000 in credit card debt or line of credit debt, and your cash flow is terrible or is negative, and you simply just can't get your head above water. And so what happens in that case? And you want to refinance your mortgage to naturally bring in the credit card or the line of credit debt into your mortgage to pay a lower interest rate and to have positive cash flow. What happens in that case when you can't do that? Should you be forced to sell your house? I think not, because that would really, I shouldn't say I think not, like it really just depends on the situation, but I don't think I don't always think that selling a property is the right thing to do, because there's also costs associated with selling a property. So I hope that also answers your question, Blair. Hello? Hello?
I am so sorry. I left myself muted.
That's fine.
Blair also had another question. In what provinces can you operate or have affiliations, and who should contact you? Okay,
so my mortgage license says that I can only facilitate a mortgage in Ontario. So across Ontario, we can facilitate a mortgage. However, if someone needs my help in, say, BC or in Alberta, or I think someone called me from Saskatchewan yesterday, whatever 303 area code is. I'm pretty sure that's Saskatchewan. So what we do is we can still broker the deal. We will reach out to a partner of ours in Saskatchewan, and so we'll provide the service, but we will do it on I think we do it on their quote unquote paper. So it lines up with the way we're supposed to operate our license. So yeah, so we can still do that. So we can technically operate across Canada. We'll just co-broker the deal with someone in Alberta or Saskatchewan or whoever.
Okay. So there are no other questions from any of our audience, but one of the other things that I was curious about is, as we all know, clients are often pretty attached to their family home. What do you do in situations where one spouse wants to stay in the house but doesn't qualify for a conventional mortgage? And are there other options for this person?
Yeah, so I'd like to say that there's always a solution somewhere. So so we have clients who sometimes they if they can't, sometimes they need a cosigner, sometimes they can't have a cosigner. When we talked about one of our first slides, or probably one of our first 5 slides, was there's always an alternative lender who, based on risk, will lend to a client. We've been able to get a mortgage done for somebody who was in the process of a separation. I think it was a $400,000 mortgage, and I think we needed to show 20 or 25% in RRSP money. So during the negotiation, during the separation negotiation, the lawyer, we spoke to a lawyer, and the lawyer negotiated that the client would get over $100,000 worth of RRSP money. We were able to show those assets to the lending institution, and even though the client technically didn't qualify for a mortgage, but because the mortgage product that we were able to qualify her with was one that you just had to prove assets of 25%. I say liquid assets, so you would use cash, GIC, or RRSP. Pension money did not qualify for this. So during their negotiations, they negotiated that, and she was able to qualify for a mortgage. So there's always a way to do something. We just have to put our creative hat on to make something work.
Okay, understood. Let's see here. I think that's about all we have for right now. Is there anything else you feel like we should know before we all hop off?
Not really. I would encourage, especially someone like Blair. Hey, Blair, honestly, if you're still on the call, I appreciate your questions. Feel free to pick up the phone, give me a call, or send me an email. I'd love to have a conversation with you. It seems like he had some really good questions. And for those of you that really appreciate the conversation and found value to it, I'd love to have a conversation with you also. But if you're referring me, the absolute best way to refer me is to give me a call first to say, hey, here's the situation, or whatever. Really, we can talk for whether it's 5 minutes or longer. But and kindly just email me provide an email introduction to the client. And most people do that. They'll say, to client X. They copy me. They provide an e-introduction, providing the client's contact information, and then we really just do the rest, and then we circle back with the referring party and just say, hey, listen, we were able to reach them. We really appreciate it. Looks like we have a deal here. Thank you very much, and go from there.
All right, John. Well, thank you so much for presenting for our Canadian CDFA members. As he mentioned, if anyone has any questions, all of his contact information is listed in the presentation. And in our follow-up email for the webinar, we will actually be sending out a copy of these slides, the recording for this presentation, as well as John's contact information again. And as Sheena mentioned, on the beginning of this call, our early bird pricing for the 2017 IDFA conference in Toronto is ending on Thursday. So definitely make sure to go over to institutedfa.com and check out the conference. It should be a really awesome time. Great presenters, great speakers. And that is about all I have. Again, thank you, John, and thank you, everyone, for joining.
Thanks so much. Appreciate it.